The first area I'm going to look at is neuroeconomics. Neuroeconomics is an interdisciplinary field that seeks to explain human decision making, which is the ability to process multiple alternatives and to follow a course of action. Neuroeconomics studies how economic behavior can shape our understanding of the brain and how neuroscientific discoveries can constrain and guide models of economics. There are studies going on to determine which brain areas are active in which types of decision processes. Neuroeconomists hope to better understand the nature of suboptimal and illogical decisions. The major research area in neuroeconomics is decision making under risk and uncertainty. Almost all decisions are made under some conditions of risk. Neuroeconomists are studying to find out what areas of the brain are used more when risk is involved. This is a way they hope to understand how and why people trade on the stock market like they do. It is said that risk is grounded in our hormones because successful risk-taking releases dopamine in the blood. Dopamine, which is considered a pleasure hormone, leads to addiction and could be an explanation as to why some people are addicted to taking risky chances and always trading stocks. Next is financial bubbles, or dot-com bubbles. They have a historic speculative bubble covering around 1997 to 2000, during which stock markets in industrialized nations saw their equity value rise rapidly from growth in the internet sector. In financial markets, a stock market bubble is a self-perpetuating rise or boom in the share prices of stocks of a particular industry, such as the housing industry. The graph shows the path a share price would normally take if it was covered by the stock market bubble. It would slowly take off, and then there would be the huge jump in price when it went public, and it would hit its top before going down and returning to the mean. And finally, some people may ask, who is to blame for the bubble market? Actually, our brain is to blame for the bubble market because everyone always believes that someone knows something they don't and they want to figure out what that something is. The theory of mind comes up with this because the ability to know what someone else is thinking is not an illusion. Bubble markets and neuroeconomics go together because they both deal with the brain and how decisions are made and what parts of the brain it affects.